There it is.
Good morning, everyone. This is Steve Hoffaker. Welcome to another one of our professional development webinars for 1 hour of CE on a CAPS, Certified Agent in Place Specialist related topic for contractors, therapists, designers, durable medical equipment, anyone in the agent in place field. Today we have a special opportunity. We hear a lot about through TV advertising, word of mouth, reverse mortgages as a way to finance home improvements. So let's go right to the source. And we have two experts with us today who will walk us through some of the ins and outs. And this is not a dog and pony show, I understand. We're actually going to look at some of the pluses and not. So you guys can make an educated decision in how to promote that to your clients. Join us again on May 7th for our next program. More on that later. Check the website. But without further ado, Suzanne Soderberg, and I'll let you introduce your team.
Very good. Thank you so much, Steve. And thank you everyone for being here today to learn about the old reverse mortgages. As I like to call them, I trademarked the name Senior Equity Access Loan. So I'm calling myself a SEAL specialist. Just because we know the connotation and the stigma that's been out there for reverse mortgages a long time ago. So Ken and I are out here to change the world and let everyone know that, it could be a great option. And like Steve said, he asked me what's the name of the class, and I said, why don't we call it the good, the bad, and the ugly? So it's not going to be all roses and rainbows, but we want to have you, understand the program, the pros of it and the cons of it, and just how it can possibly fit into the clients that you work with. So my name is Suzanne Soderberg, and then like I said, I'm a senior equity access loan specialist and also a certified divorce lending professional, but that's something for somewhere else. And my cohort today is Ken Sawan, and he is our national sales manager of reverse mortgages. And I'd love him to introduce himself as well.
Thanks, Suzanne. I don't know about a cohort, but I love working with Suzanne. She definitely has a passion for the program, which makes my job a lot easier. Steve, thank you for the invite. And as Suzanne said, I love the title, The Good, the Bad, the Ugly, because I've been doing these since 1991, so 33 years as of this September. And I've seen all the good, the bad, and the ugly of the program. I will also be the first to admit it is not for everyone. And it's our jobs, those of us in the reverse industry that do it the right way, to make sure all interested parties understand what they're getting into. They understand that it's a great opportunity for a lot of people, but it is not for everybody. And we want to make sure that they understand it, and it'll make our job a lot easier. So today, we don't have a real long presentation, but what I like to do is go over the basics of the reverse mortgage first. And then we have some scenarios, obviously using it to do some remodeling for seniors to age in place is a huge reason to get a reverse mortgage. But before we get to some of the scenarios, I want to go over what it is, kind of from a high level. And Suzanne and I will kind of tag team as we go through this presentation. I can't see all of you guys, but one of my original questions that I'd like to ask is, who's had experience in the reverse mortgage, good or bad? You don't need to answer this right now, obviously. Generally, though, the information, when somebody responds back with some negative information about the reverse, and to Suzanne's point, it has had a lot of challenges in the past. But between the consumer, the CFPB, the feds, HUD, they've all really inputted more consumer protections for both the borrower and the lenders. It's basically the same program it was back in 1989. It hasn't really changed. What's changed, though, is the protections. And I think the protections, coupled with the knowledge that the lenders have received on how to explain the reverse mortgage, has definitely made it a much safer and a more accepted mainstream program. But we'll talk about that in a little bit. So The product that we're really going to talk about today is insured through the federal government or the FHA. It rolled out in 1989, and the FHA calls it a HECM loan, a home equity conversion mortgage. You may have heard that term. We know it as a reverse mortgage, or as Suzanne says, a seal loan, which I love that, by the way. Basically, all it does, it allows a senior, you have to be at least 62 years of age, to tap into a portion of the equity in their home, their principal residence. It cannot be a vacation home or rental home or nothing like that. It's got to be their principal residence. And as long as they live in and own that property, they never have to make a payment back on the reverse mortgage, which is why it's called a reverse mortgage. Throughout this presentation, think about it as a regular mortgage without a payment. That's really what it is. We don't take control of the house when the borrower passes. We don't throw the borrower out because we want the house. It's a regular mortgage. It stays in the borrower's names. We are going to put a mortgage on the property with the reverse mortgage. And eventually, the due and payable clause will be activated, but we'll talk about that in a moment. If this is a husband and wife, we use the age of the youngest borrower. So if the one spouse is 65 or one spouse is 75, that's still allowed, but we are going to use the age of the youngest borrower to calculate how much they're eligible for, which we'll talk about in a moment. In every state except for Texas, you can have one borrower under 62 as long as the other borrower is over 62. This is prohibited in Texas for some reason. I think they're working on changing it, but it's not here yet. So unlike years ago, where both borrowers had to be 62 to qualify, now one can be under 62 as long as the other is over 62. Okay? Next slide, Suzanne.
And then, like he
here's-
was saying, that the older the borrower, the more money they're eligible for. So I always tell the families that I'm working with, when I'm in my system, it's not as easy as a forward mortgage where I say, okay, well, you can qualify for this, or your loan amount will be that. There's since it goes off of the age in my system, what I do is I put in their address and their birthday. I kind of can create a dummy file, as you will. But it will give me the amount that the borrower will be eligible for. And like Ken said, in the case of a couple, the youngest borrower's age is used. Like I have a mother and a daughter right now, and the daughter is 68, and then the mom is in her 90s. So the mortgage is going off of the daughter's age, of course, but it's still going to work out for them. And what the part that they need is for aging in place for the mom, but they're never going to have a payment. So they're just trying to decide, do they want to get a monthly flow, or are they going to take, a lump sum for their health needs? But there's, no matter which way you choose to do it, there is never going to be a mortgage payment, shall you say. There's the taxes and insurance, but never the mortgage payment.
Yeah, Suzanne, good point. They are always responsible for their property charges, and this is very important. A lot of these folks that had a mortgage on the property that we use the reverse to pay off, which we can, since they haven't made a payment on their property charges because it was escrowed, if we pay off a forward mortgage, a current mortgage, they will now have to pay those out of their pocket or with the proceeds of a reverse mortgage. So it's very important that as we discuss this with our borrowers, and you do the same, that they are still responsible to pay their taxes and their insurance. That second bullet point there is important, as Suzanne said, but understand something. They can make a payment back on the reverse mortgage if they want. They don't have to. And I'm going to guess maybe 10, 12, 15% of our borrowers do actually make some sort of payment, because think of what happens. If I lend somebody $200,000 today and I charge them 7% and they are not making a monthly payment, that mortgage balance grows over time, which leads me to one of the downsides of a reverse mortgage is potentially it's going to eat up a good chunk of the equity in their home. So think about it. I'm charging you 7% and you're not making a monthly payment. So at the end of the first year, if I gave you $200,000, you're going to owe back $214,000 at the end of the first year. At the end of the second year, you'll owe back $230,000, and it continues going up unless, of course, someone's making payments on it. Why that is a bad thing is because you're leaving less money to your children or your estate or your heirs, whoever that may be. So one of the things we tell the borrowers, if you really care what you're going to owe back on this reverse mortgage when you pass away, this may not be a good opportunity for you. It's truly for the borrowers today when they're alive. Again, they can age in place, they can become more financially independent, but that's one of the negative parts of the reverse mortgage is it is going to grow, the balance is going to grow over time. And also understand, as Suzanne said, the older the borrower, the more they get. Conversely, the younger the borrower is, the less they get. So, and by the way, everybody, if you have questions, feel free to chime in. Just interrupt us. Next slide, Suzanne.
I'm glad you said that. I was going to say that as well, that we're informal here. So if you have a question, just chime it right in while you're thinking of it, because otherwise you might forget it. But also with the mortgage, the reverse mortgage, there's several ways that they can get the money. They can get a lump sum payment at the closing table. They can get a monthly disbursement, if you will. So let's say they need, $2,000 a month to live or for their expenses or what have you. It's called a tenured payment. That next one there is where they can get a certain amount over their life expectancy. Then if there's some money that they can put into a line of credit, that credit line or line of credit is going to grow as year over year. So, and it grows typically, I want to say the mortgage insurance premium amount. So maybe about 0.5% over what the interest rate is, but that's going to allow them to tap into more equity in the home down the line. And as Ken said, if you want, you can make a payment. I know when I turned 62, and Ken and I have talked about that, I want to put one in place, but I'm probably going to be in that 5 to 15% that would make their payment, just because I want to see my balance go down. So like I tell people when they don't understand the reverse, I say, think of it opposite of the forward mortgage. A forward mortgage, you take out a loan and the loan balance decreases over time. Whereas a reverse mortgage, you're going to take out a loan and it will increase over time. Kind of like that old negative amortization type loan, where if you don't make enough of the payment, your balance will increase. This one is increasing by that interest on there. So that is one of the things. But like Ken said, you do not have to make a payment if you don't want. It will just eat away at some of the equity in the home to leave the estate, the heirs, the children, what have you.
So one of my things, Steve, can you go back?
Yep.
One of the things that I'm very passionate about is everyone who does a reverse mortgage, if there's money available, they should put it into this line of credit. And just to expand on what Suzanne was saying, unlike a regular HELOC that you get at a bank or a lender, our line of credit with the reverse mortgage grows at 0.5% over the interest rate on behalf of the borrower. So if I'm charging the borrower 7% on the money they borrow, this line of credit will grow at 7.5%. And it'll continue to grow as long as the loan is in good standing. You got to pay your property charges, you got to live in the house, all that kind of good stuff. I'm a huge believer in Suzanne. I'm right down there with you. As I get old enough, I will also do a line of credit for that reason. But it's just something that's very, very popular in the reverse mortgage because there's nothing like it on the market as of today. Going back to the monthly payment for a specific term, we see a lot of folks who are in need of in-home health care, which might come right down the path with you folks doing the caps and in the consulting. You can utilize a reverse mortgage proceeds for a specific number of years, 2 years, 3 years, 5 years. And generally, we see it for folks who want to use it for in-home health care. But again, it's a very, very flexible program. And even if you close your reverse mortgage and you choose one particular payment option, let's say a year goes by and you want to change how the money's being distributed, for a mere $20, you can have the entire payment plan changed. So it's very inexpensive. It's very flexible, especially as our seniors' lives change and they develop additional needs or concerns that they bump up again. And again, as long as they live in and own the property, the mortgage does not become due and payable. Now you can move on.
Okay. And then one other quick thing with the line of credit, as we think about it compared to a home equity line, one of the things that we like to say is that with the line of credit, that's yours. That money is there. The bank can't shut it down, because if you remember back when all the stuff was happening with mortgages and the home equity lines and property prices were going down and the bubble and everything, people's lines of home equity lines of credit, the HELOCs, they were getting frozen. They were getting shut down where people didn't have access to it. Whereas with the line of credit, that will not happen, or it should not happen with the reverse mortgage. So I wanted to throw that in there as well.
Good deal.
So then how do they work towards the end? So because a lot of people think that the bank just wants to take over the loan, but once the last borrower has either passed away, or if it is they've moved out and they've bought another home or whatever, or it's no longer their primary home, they've moved to another area, then that loan is going to be due and payable. So that's going to be when they have to pay it back. If they don't, what happens when the last person has passed, the estate, so the kids would end up having to do something with the home. I'm trying to think if we get to that a little bit later. And they can either refinance into their name, they can sell it, or what have you. So, and that's right down there. So the estate, however, to pay it back, sell, they have up to 1 full year, and they do that in 90-day increments. So they're gonna sometimes, I mean, things have changed. Things aren't, houses aren't flying off the shelves right now. So they try to do it within 90-day increments, trying to sell the home to get out from under it. And they said they can refinance it, use other investments to pay it off, or like Ken and I have said before when I've chatted about it, that if they're upside down, which we'll talk about later, that the estate, the family, the children, whatever, is not liable for that deficit. So if they don't want to take the time to sell the home, they can just turn it back into the bank and hand the keys and say you sell it.
Yeah, here's the bottom line with this, everyone. The estate cannot just sit on this property. They have got to do something with it. If they're going to sell it, get a realtor. If they're going to refinance it, get a lender. They've got to do something with this. What Suzanne was alluding to is the estate nor the borrower can never be responsible for anything more than the value of the house upon death or sale. So going back to 2008, 2009, where we had the correction and people lost 30–40% of the value of their home, if the reverse mortgage the reverse mortgage balance is greater than the value of the home when it's sold, that does not become a detriment to the borrower or the estate. There's a built-in mortgage insurance in here that will take care of that deficit amount. And it will not affect the estate at all either in terms of a credit risk. We do talk about that shortly, I think, Suzanne. But okay, that's one of the consumer protections that have been put out there forever and ever, is the estate will not inherit any additional debt other than the sale of the property. Of course, if the estate sells a house and there's equity left over, the estate gets that money as well, just like a regular mortgage. Okay. Next slide.
There we go. And then, as we've talked about before, the responsibilities is that the borrower must live in the home as their primary principal residence. It cannot be an investment home. It can't be a second home. They can take out money to buy a second home, but the house that they are in, that the reverse mortgage is on, must be their primary residence. And the borrower must also pay for all charges to the home, the property taxes, the homeowner's insurance. If there's any homeowners association dues, those must be paid for. I know out here we have a ton of those everywhere. And that they have to keep up the home, and they say to FHA standards, so they can't, you know, let it run down into the ground or anything. Like, they have to keep it up to be, you know, livable and everything. And if they don't do anything, if they don't do all this, then they can be in default, and then the loan would be called in due. So as I said, they must maintain the home and abide by all the regular terms and conditions of the reverse mortgage.
And some of those terms where it says abide by terms, some of those terms could include, you cannot do an Airbnb on your house, say for instance, after you get a reverse mortgage. They will not allow that. If you do that and they catch it, they will tell you to pull it off the market. So again, abide by the rules. And one of the things that when I'm giving presentations in front of large groups of folks, one of my original questions is, anyone have any, as I mentioned before, anyone have any experience in a reverse mortgage? And inevitably somebody in the group's going to say, oh, I have. I heard they're a really terrible thing. And I would say, why? And they say, well, because, 2 years ago, my friend lost their house because the reverse mortgage foreclosed on them. Then I will say, why'd they foreclose? You don't make any payments on a reverse mortgage. Were they paying their property charges? Oh, no, they didn't pay their taxes. Well, that's not us. That's the county foreclosing. So as long as they abide by these few points here, you can never foreclose on a reverse mortgage. Pretty safe. Next slide, please.
I'll let you do this one here.
All right, thank you. So prior to 2015, the thing I like to say is if you were at least 62 years of age, you had equity in your home and you were breathing, you were probably going to get a reverse mortgage. We didn't care about bankruptcies. We didn't care about your income. We didn't even pull credit reports. Now, after 2015, the feds decided to put what we call financial assessment in place. And basically, we have to underwrite these files to make sure that after a reverse mortgage is completed, does the borrower have enough income to pay their monthly expenses? When we enacted the financial assessment protocol, our foreclosure rate on reverse mortgages went from about 13% down to under 2%. It's probably closer to 1% today because people didn't understand it. People couldn't afford to pay their taxes. It was a disaster. And I think this is where some of the reverse mortgage got its bad reputation. So we now have to underwrite these. We pull credit. We look at their income. We want to make sure that the borrower is making their payments on a timely basis. And as long as they pass the financial assessment, we're good. If they don't pass it because they had some credit that was delinquent or they didn't pay their taxes, we have an escrow account called a life expectancy set aside. I'm not going to get into this too heavy. But basically, even if somebody has poor credit, we can probably still do a reverse mortgage for them, although we have to establish a escrow that will take care of their taxes and insurance on their behalf. All right. That's really what the LISA, the life expectancy set aside, is all about. It's to assist those individual borrowers that had some problems with their credit or paying their property charges in the past 24 months. So just because a borrower says I have bad credit doesn't mean we cannot help them with the reverse mortgage. We just have to jump through a couple of different hoops. And of course, when we do the calculation on what someone's eligible for, as we kind of touched on, we look at age, interest rate, and home value. That will calculate how much someone's going to receive. And as I mentioned, if it's a husband and wife, we use the age of the youngest borrower to calculate that. Next slide.
And then I'll just throw in, when we were talking about the LISA, the life expectancy set aside, I had a girlfriend that I was trying to work with. She was in the middle of a bankruptcy, a BK13, and she had had some credit issues in the past. And she explained some of the things because she was going through cancer treatments and everything. But we were able to get her done by doing a LISA. So they just had to take out of the equity of the home enough money for the expectancy of her life for the taxes and the insurance. She didn't have any HOA fees. So that was a great, well, not a great situation for her, but proof that Lisa does work with someone that doesn't have perfect A credit, that we were still able to get that loan done, and just on her Social Security income, not even her job. So
Good
just
call.
throw that in there.
Yeah, and to Suzanne's point, if the delinquent credit or the delinquent property charges were a result of what we call an extenuating circumstance or a once in a lifetime issue, such as the death of a spouse, in Suzanne's case, her friend, cancer, which affected her ability for more income, we can then waive the LISA or the escrow account. So there are some benefits if we can determine that the once in a lifetime event resulted in the delinquent credit. You want to take this? You want me to take it?
No, I can do it, and then you can add in.
Okay.
But like we said before, that if the loan goes upside down, and let's say that you owe $350,000 on the reverse mortgage, and you can only sell the house for $300,000, that $50,000 is basically forgiven on that. The mortgage insurance takes care of that for any deficit of that. So it's as we said before, the estate is not liable for it, the heirs are not liable for it, borrower is not liable for it if they were to move out or anything like that. So but then any equity, if it were the other way, and they could sell it for $350 and they only owed $300, then that amount, the $50,000 minus the cost, of course, but the $50,000, that would be the equity that could go to the estate, the heirs, etc. And like I said, that mortgage insurance is there, so to take care of any deficit of the amount, like that 50,000 or 20 or whatever it may be.
Let me piggyback on that. One of the other things, if somebody raises their hand and says, this all sounds too good to be true, there's got to be a catch. Well, there's not really a catch, but as I mentioned earlier, it is potentially going to eat up a lot of the equity in the home, and these things are very expensive. Part of the reason is because of that mortgage insurance. So let's use a $400,000 home value, just because that sounds good. On a $400,000 home value, your mortgage insurance that's charged by the FHA to protect both the estate and the borrower is 2% of the value. So right off the bat, on a $400,000 home value, you've got $8,000 in mortgage insurance. Now these fees are financed into the loan. It's not coming out of the borrower's pocket, but regardless, it's still expensive. Additionally, the lender, Benchmark, will charge an origination fee from between $2,500 and $6,000. That's how we get paid to do these. So you have $8,000 going to mortgage insurance. You have $6,000 going to us. So what is that? 14 grand. And then you've got your typical state costs. Let's say it averages $3,000. Well, let's go $4,000. So you've got 8, 6, and 4. I mean, you've got $18,000 in closing costs on these things. And again, to me, that's one of the biggest downsides to the reverse mortgage. If you don't care what happens to your home when you pass away, great. That takes care of that issue. But now you got to deal with $15,000, $18,000, $20,000, $24,000 in closing costs. Some of those are to your benefit, obviously, the mortgage insurance. So that's definitely a downside. The borrower does receive an estimate of closing costs when we run a scenario for them. So they see all these numbers and everything. We don't hide anything on it. But it's just something that if you haven't had a mortgage on your home in 20, 30, 40 years, it can be some sticker shock for these folks. But again, we take our time to explain what each fee would be. Suzanne?
Yep. All right. And then some of the consumer protections is that there is a mandatory counseling class that the borrowers must go through. I believe it's for just one. And actually, I should probably let you take that one. I know you had mentioned something to me the other day that was newer, so I jumped ahead of myself.
So before any lender out there can do any sort of processing on an application for a reverse mortgage, the borrowers, all borrowers or anyone with an ownership interest in the home must be counseled. Reason being is we want to make sure that the borrower understands what they're getting into. They have the mental capacity to understand it. That's very important. And they understand, and nobody has pushed them into the reverse mortgage, not the lenders, not you guys, that they're doing this on their own accord. But in order for them to do it on their own accord, they have to understand, as we like to say, the good, the bad, and the ugly of the program. We now allow what they call non-borrowing spouses to be part of the program itself. A non-borrowing spouse, as I mentioned earlier in this presentation, is a borrower who is under 62 years of age, but it's a husband and wife, and if one is under 62, the other one must be over 62. Prior to the non-borrowing spouse rule being enacted, if you had a spouse who was under 62, they would have had to come off title. That caused all sorts of problems, as you can imagine, once the borrower passed away or if the borrower passed away. And again, with the exception of Texas, every state has the non-borrowing rules in effect. There's also a lot of disclosures. We have to disclose every loan, every reverse loan the borrower may be eligible for, as well as there's a lot of documents. There's state documents, there's lender documents, there's federal documents. So these loans are quite hefty. Suzanne, I think the application is 85 pages. Does that sound about right?
Yeah, like 85, 86.
Now, they don't sign them all, of course, but there's a lot of disclosures in these things. We also send out, per law, a statement. It can either be a paper statement or a web-based statement. Obviously, web-based can be a little bit more security conscious if they don't want to, a paper going to their house. And as we talked about, stricter guidelines, which is a financial assessment on qualifying for a reverse mortgage. And when we talk about willingness versus capacity, when we talk about the willingness of a borrower, are they willing to pay their bills when they're due? Meaning they have enough money, which is the capacity part of this, but they say, I don't want to pay my bills because I got mad at my bank and I decided not to pay my credit card. Well, you can't do that. You still got to pay it. But that's where the whole escrow comes in. So these are things that we look at as a lender to make sure the borrower is going to be able to afford this home when they pass away. Next slide, please.
And then I'm just trying to keep my eye on the time. So I know that we're going over a lot of information. We have several more, so I'm probably going to go a little bit quicker on these, but please jump in if you have anything. And I also want to leave if you have any questions at the end as well. So here's some myths that you probably hear out there, or maybe you believe in them, that the lender owns the home. Well, the lender doesn't want your home. So the borrower always maintains the ownership. And only when the loan closes, then just like anything else, the lien is filed, for that property. So the borrower never loses ownership in their interest, because like I said, the bank doesn't want all these, homes or anything. The estate will be held responsible for the mortgage, as we said before, that only the reverse mortgage, they're only responsible for that balance. And if it goes upside down, then that mortgage insurance will take care of any deficit on that. A lot of people think that the home must be debt-free and owned free and clear, and that's not true as well. I know I've had people, and like I said, I don't know exactly the amount of the loan that can be taken out. So I put it into my system and it gives me the amount. So as long as that reverse mortgage can cover the paying off the balance of the loan, then a reverse mortgage can be received. Anything to add on that, Ken?
No, that's good. Good job.
Oh, thank you. Some more, like we've said before, there'll be nothing left for the estate. And as we said, as long as there is equity left in that estate, then it will go to the heirs, the estate, what have you. In the case of my scenario with the 350 and the 300, so the $50,000 would still, be given to the heirs of the estate or what have you, or the seller. The borrower can't sell the home if they have a reverse mortgage on it. And I tell people all the time, these are regular loans, just like any other conventional forward mortgage loan. There's a loan out there and it pays off just like any other one. And if there's equity left, you get it. Just like on a forward mortgage, with whatever equity is left in there, you get it there as well. Then they think that the terms can change once the loan is closed, or if it's transferred to another servicer or what have you. And that's not true as well. As I tell people with a forward mortgage, if it's a 30-year fixed rate, your rate is your rate and your payment is your payment. The only thing that would change that payment is if your taxes or your insurance change. So that's the only thing that would change as well. Is you don't have to make a payment if you don't want, but you do have to keep up the property, taxes and the homeowners insurance and any HOAs, et cetera. Anything else on that one, Ken?
Yeah, let me jump on point one. The average reverse mortgage currently lasts about 10 and a half years. So these things aren't going on for 20, 30 years. Generally the borrower passes away, they sell the property, they refinance, they do something. So the chance of a good chunk of cash being left for the estate, if that's the concern, is probably pretty good. Otherwise, yeah, this all makes sense. And again, you can sell the house. You can't change the terms once you get the reverse mortgage. Next slide. You can blow past this.
Okay. There we go.
So we decided to put together some scenarios. Do you want to handle these, Suzanne?
Oh, you can go ahead since you're already on it.
So we see a lot more of this, and I'm sure all you folks have heard about the phrase or the motto aging in place, which obviously if you haven't heard about it, there's a movement out there in our world that basically says, how can we keep the senior homeowner in their home? And using the reverse mortgage has really enabled a lot of folks to stay in their home as opposed to moving into a nursing facility or some other adult facility where they need assistance. Instead of them going to the facility, we bring the facility or the care to them. So in this first example, I'm not going to read these verbatim, but this is a very, very typical case where the borrower can no longer navigate their home. They don't want to sell it. They've been there for 20, 30, 40 years, a lot of memories, a lot of stuff that they'd have to move. So instead of them moving into an adult facility, we can change the house, we can modify the home so they can age in place safely. Things like move the bedroom downstairs if it's a 2-story home, remodel the bathtub, update the kitchen. If they're in a wheelchair, put a ramp in the front doorway, whatever they may need. And I know this is not an inexpensive process, but again, the reverse mortgage will give them a bucket of money without them incurring any additional debt. And of course, there's no monthly payment. So we're going to go over a couple of different ones that are not really cap related, but it just kind of gives you a chance to start thinking outside the box a little bit. Next slide.
Go ahead.
This is a client that we actually, these are actually true case examples, by the way. We have a client here who wants to retire, but they have a fairly large mortgage payment on their property. And as Suzanne said earlier, your home does not have to be paid off to qualify for a reverse mortgage, as long as we can get you enough money from the proceeds of the reverse mortgage to extinguish any current mortgage or debt filed against the property. So in this instance, this borrower eliminated a $2,250 a month payment. And what is that, $25,000 a year? They eliminated that they no longer have to make. Now remember, they still have to pay their property charges. That's very important. Just because we paid off that first mortgage doesn't mean they no longer have to pay their property charges. Okay? So this guy was able to retire then. Next slide.
And then this one kind of goes back to the aging in place, needing the in-home health care, that we had someone that was 98-year-old mom, kind of like the situation that I'm dealing with the mother and the daughter, and they're needing in-home health care 24/7. And as we all know how expensive it can be, that was about $10,000 a month. The son, who had a durable POA, just like my daughter had, for her mom, was able to get the reverse mortgage and generate close to that 650. So they also need repairs on the home, as we talked about in that first scenario. So with the money that kind of like this one, mine has Social Security and some other income that was coming in. But this one, they were able to get that monthly draw. Like we said, we can get a monthly tenured payment for X amount of years based on the life expectancy, et cetera. And this client was able to get $8,000. And then from the additional investments, they had $2,000, whereas my borrower had the Social Security, which was about the same, maybe a little bit more. And that was able to pay that $10,000 monthly bill for the in-home health care. So, and then with that extra money, instead of putting it into that the line of credit that you could do, they had additional funds to bring the house up to code, like we said before, with the ramps or the lowering of the cabinets, the walk-in shower, anything like that that you might have to run into. And of course, no monthly payment required on that. So that's another scenario that kind of mirrors the one that I had just done.
Let me jump in there for a minute. So that brings up a good point about the repairs. Homes have got to be up to minimum zoning standards or what FHA. If you have missing handrails or you have a leaking roof or peeling paint, and a lot of our borrowers sadly have these issues because they don't have the money to pay for these repairs. We can use the reverse mortgages to do repairs as well, on top of any sort of additional things they may need just to age in place. Okay. You want this one or you want me to take it?
Oh, go ahead.
So in this instance, this borrower, she lost her husband. She lost half of her income, and she still had quite a bit in credit card debt, a car loan, and a small mortgage. And we were able to basically use the reverse mortgage to pay all that stuff off. It freed up about $3,000 a month on her monthly payments. And she also decided to take a small lifetime payment of about $500, I believe it was. So in this instance, we utilize the equity in the home to take care of some expenses that she incurred as a result of the death of her husband. This is a great story. Sadly, it happens a lot in our world. People don't understand that when you lose your income from a spouse passing, doesn't mean your debts go away in most cases. So she was still responsible for all this stuff. Next one. I think this is the last one.
Yep, this is the last one. And this one is not my friend, but it reminds me of that. She had just turned 62, had the credit issues, like I said, with the BK13, had fallen behind in some credit card debt and everything. So with her, we were able to, get that loan. And in this scenario, he needed about $50,000 to pay off all those credit card debts that he was behind on. And because he had been behind on some of them, we were able to get that LISA, the life expectancy set aside for the taxes and the insurance impounds, as we call them. I call them for the escrow account to be collected and paid for. So based on his age, and for his life expectancy, that needed about $80,000 had to be created to take care of that. So now, instead of him being responsible for paying the taxes and the insurance and everything, which have to be paid, because of that life expectancy set aside account, the mortgage would now take care of paying those property taxes and insurance. So now all the credit cards are paid off, the property charges are now paid, and the borrower has that line of credit for $50,000 that he can use for future needs, and no mortgage payment required. Anything to add on that?
We have a saying that we say, house rich and cash poor. So a lot of these folks that do a reverse mortgage, they live in paycheck to paycheck. They've got, 2, 3, 4, 5, 600,000 in equity. How do we tap into it? This fits in beautifully with that mindset. Is that the last one?
It is, because that's me.
Very good.
I don't know if there's any questions. We want to thank you for coming, but open it up for any questions that we may have, stirred up in you, or anything else that we didn't cover that you encountered, or questions that people have said that you'd like answered, or anything like that. Anyone? Feel free.
It's a pretty
Nope.
thorough presentation, but any questions at all that you might have?
Well, if you do end up coming up with any, my information is on the screen there. So please feel free to reach out anytime. You can text that number. That is my cell number. And then my email. And that's also my website is suzannesoderberg.com. But I would love to be of service, be a resource for you. If you have any questions, like I said, that come up, it's what I do day in, day out. So I would be more than happy to, have you give a call, say, hey, heard you on the seminar, the webinar that we had, and I had a question for you, and I'd be happy to answer it.
Terrific. Appreciate your willingness to do that. So if there are no other questions, we'll wrap this up for today. Join us again next month on May 7th for our next presentation. Suzanne, Ken, thanks so much.
Thank you so very much for having us today. It was nice to meet everyone.
And all of you who joined us today. Thank you.
Take care, everyone.